Hi, I'm Jocelyn with CoMortgageResource.com. In this video, we're going to talk about the 7 dangerous mortgage loans you should avoid. The first mortgage I would definitely avoid is the balloon loan. Now, the way that a balloon loan works, and let's use an example, it'll make it easier. Say you are going to buy a $200,000 house. Well, your payments are still spread across 30 years. Sounds great. So say you're paying maybe $1,200 a month. Well, a balloon loan is going to come due at a specified time. So, for instance, if you hear it's a 5-year balloon, so that means that the full loan comes due in 5 years. Now, there's no way that over 5 years of making your $1,200 a month, you're going to have that paid off in 5 years. So, at the 5-year mark, you get this bill for probably about $196,000, and you have 30 days to pay that off. Well, the idea was you could refinance into another loan, but this is where a lot of people got into trouble because in the meantime their house depreciated and they were unable to qualify for a refinance and they were forced into a foreclosure. Do not do a balloon loan. The next question you need to ask, no matter what loan you do, is do I have a prepayment penalty? Now, while Colorado has done a good job of regulating this, I still would make sure that you're asking those questions. What is a prepayment penalty? Well, the prepayment penalty is if you pay off the loan 3 years from now, you're going to have to pay a penalty. Well, most people think, well, that's not a big deal. I won't have the money to pay off the loan. It's not just that. You can't refinance out of the loan. You can't sell the property. You can't do anything. You can't pay more on your monthly payments if you want to without incurring a prepayment penalty. The way that they're structured is usually they'd be like 3% of your loan amount. Well, if you have a $300,000 loan, that's a $9,000 penalty if you wanted to sell your house before the penalty period ended. Those can be really hefty, and I would definitely ask the question to make sure that you're not hit with one of those penalties. The other mortgage I would avoid, or make sure that you really understand the terms and conditions of it, the adjustable rate mortgage, also known as ARMs. So the way that an adjustable rate mortgage works is it's fixed for a specific amount of time and then it starts adjusting to the market. So for instance, you have a 30-year fixed, well, you know that your rate's going to stay the same for the entire 30 years. Your payment's going to stay the same for the entire 30 years. Now with the ARMs, they'll be fixed for 5 years. So say you hear a 5-year ARM. It's fixed for 5 years, then your interest rate starts adjusting to the market every year. Well, where this can get a lot of people in trouble is their payments just start going up, going up, going up. In a lot of situations I've seen where people's payments went up almost twice as much as what they started at. People go into ARMs because the rates are lower than on a 30-year fixed loan. And it's great if you absolutely know that you're going to be leaving the property, but where people got in trouble is they couldn't sell their house because in our market it had depreciated, or they couldn't refinance out of the ARM because in our market their house depreciated, so they were forced into foreclosure. Make sure you understand how your ARM is working if you're going to go after that type of a loan program. Another mortgage that I would avoid is the interest-only loan. Now this used to be a big deal, especially for investors and people in really expensive markets. It is just what it says it is. You're only paying the interest on the loan. You're never hitting any sort of principal balance. So it can be a great vehicle in an appreciating market. You're just paying the interest, your house is appreciating like crazy, you go and sell it and make a bunch of money. Well, unfortunately, the people that were doing interest-only loans, they go in, they do 100% financing, they didn't have a down payment, they're only paying the interest, and then the house that they're in starts depreciating. Well, the mortgage that they now have is higher than what their house is worth. And then they couldn't get back out of the mortgage, whether they couldn't sell it or they couldn't refinance out of it, so they were forced to foreclose. Within the interest-only loans, you used to have products that were called an option ARM, and just make sure there's also programs out there where you're even paying less than the interest that's due, so your mortgage is actually growing each month. Those are some really obstacles that you want to be careful to avoid. Now they can work for some really savvy investors, but you get caught up in a bad market and you're going to be forced to foreclose just along with the rest of them. So again, be sure you know what type of loan program that you're pursuing. And don't be caught up in the, oh, I want the lowest payment, because if it's too good to be true, probably is. For those of you that need a jumbo loan is anything that's 417 and above as far as a loan amount. If you're going after a jumbo loan, just be very careful of what program you get into, because jumbo loans, no matter what, are going to come with higher rates and higher fees. Well, now with the jumbo loans, you want to do an ARM product. They have some little bear traps out there with the ARM products on jumbo loans. With jumbo loans, the rates are really attractive compared to the 30-year fixed loans. However, on the ARM programs, they have a cap to where your ARM could adjust as much as 5% in each adjustment. So great, it starts out at 3%, it's fixed for 5 years, but after that 5-year mark, it's up to 8%, it's up to 13%. Be super careful when you're going into the jumbo loan market, and make sure you really understand the prepayment penalties, the caps on the ARMs, and what fees you're going to have to pay up front for the 30-year fixed programs. Programs I would also be a little bit leery of, and they tried to come out a couple years ago and really never took off, are the longer term loans, the 40 and 50-year mortgages. Well, the reason why people wanted those is because it spread out their payments over a longer amount of time so that they could have a lower payment. Again, it's all about getting the lowest payment possible. Well, what's hard about these mortgages is the rates comes up because they're a longer term loan. So yeah, maybe you're paying less per month, but the interest that you're paying on these loans, when you look at the bottom number, is just ridiculous. Not only that, but it takes you so long when you look at the amortization chart to even start chipping away at principal on these longer term loans, and they come with more fees. So if you have somebody talking to you about a 40 or 50-year mortgage, just make sure you understand what's the difference in the interest rate, what's the amount of interest you're paying over that amount of time that you plan to stay in the house, and what are the upfront fees that might come with them. Now, with a lot of people not being able to qualify for mortgages, well, more so than a couple years ago, the rent to buy and the lease to buys are becoming a bigger deal. Just be careful in reviewing the contracts for these, because unfortunately I've seen in a lot of situations where they're a scam, and so I would just make sure that you have a real estate agent look over your contract, or even ideally a lawyer, before you enter into one of those. A lot of times your monthly rent is going towards your, or a portion of it is going towards your down payment when you do end up buying the property, which is great assuming you buy the property. So just make sure that you really understand the details of those contracts. Right now rates are so low, so just stick with the mainstream mortgage programs. I mean, to be getting a 30-year fixed loan in 3%, 4% range is just unheard of. So play it safe, especially in a market where playing it safe is really no risk at all. If you want full access to this article, click at the link below. The article is titled "The 7 Dangerous Mortgage Loans to Avoid."